Hi, Jason Watson here, Watson CPA Group. Today we're going to talk about maximizing our 401k and our SEP IRA contributions. This is a common question we get. People want to max out their they max out their 401k or their SEP IRA. And we get it, we understand why, all those things. So let's just kind of run through some examples, especially between 401k and SEP IRA. I think that's probably one of the biggest questions that we get often, like should I have a 401k or should I do a SEP? SEP is old school. It's kind of in crisis mode. You could be March 1 about to file your tax returns for your business and you can create a SEP IRA for the previous year, just like you can do right now as an IRA for your individual. A 401k completely different. That must be installed, implemented, deployed, whatever, by the end of the year, 12/31. So 401k takes a little bit more on the planning side, where SEP is more like, oh crud, I forgot to do this thing, and we can go back in time and get that SEP IRA opened up for you. SEP is also old school because it was way more economical. The fees were low and all the options were available, were cheap, and all those things were great. 401ks are like, oh, that's for like IBM or Google. I can't afford a 401k. Now the cost of an individual 401k, a solo 401k, however you want to brand it, is very economical, and it's almost identical to a SEP IRA. The benefit of a 401k too is you get a $500 tax credit, or up to $500 tax credit for opening up a small business retirement plan. So we're seeing more and more 401ks out there. Again, solo 401ks, individual 401ks, I-401ks, whatever you want to call it. A 401k is generally a SEP plus 19,000, and that's for 2019. So whatever you could do in your SEP, and again, this is assuming an S corporation. We'll talk about transitioning out of LLC to S corp here in a bit. But whatever you could do with your SEP, let's say you could do 10,000 max, something like that, you can actually do SEP plus 19,000, or in that example, 29,000. 19,000 is the maximum deferral that you can do for those under the age of 50 in the year 2019. So if you're watching this a decade from now, I'm sure that 19,000 is probably higher. Why? Let's kind of run through how this works. So again, we're going to assume an S corp in this example. We can go through the LLC here in a second, or at least discuss it and touch it. You are the employee. Remember, as an S corp, you're wearing two hats, investor and employee. Employees get paid. They get paid via salary. People who get salaries can maybe do 401k deferrals. So you are the employee. EE is our shorthand for employee. We didn't make that up. That's been around for decades. You defer 19,000. Cool. The corp, the S corp, the company, the ER, the employer, another shorthand, again, not invented by us, does 25% of wages. So this is the same for 401k and SEP. This part right here, this corporate contribution of 25% of your wages, that's identical for SEP IRAs and for 401ks, that limit. That's why 401k equals SEP plus 19,000, because of the employee, your deferral, okay? The max for 2019 is $56,000. How do we get there with a 401k? You contribute 19,000, like we said here. The company can do 37,000, but it's a percentage. You can't just write a check for 37,000. It is limited to 25% of your wages. So, doing some simple math here, you need to have a salary of $148,000 to be able to max out your 401k. Now, there are some things we can do here. That's total compensation. So there are other things that go into total compensation besides wages. Health insurance and some other things are things that I'm thinking off the top of my head. So it's not just salary, it's total officer compensation, but just understand that it's going to be limited to 25% of that number. So let's just say for grins, we have to pay ourselves $148,000. That's going to be then how you max out your 401k. You can also use your spouse to help buttress this. Let's say we don't want to pay ourselves $148,000. And there's a lot of reasons why we wouldn't want to do that. Payroll taxes is a big one, right? Social Security and Medicare. We have a whole nother video coming up on the cost of excess payroll and why you shouldn't do it. We'll talk about that later. You can have your spouse. So let's say you have maybe like $56,000 laying around, or maybe you have $38,000 laying around. You could defer $19,000 yourself, and then your spouse could do the other half of $19,000. Though your salaries could be very, very low, you could pay yourself $25,000, for example. Same for your spouse. So you have a total salary of $50,000 between the two of you, and you're deferring $38,000 of that $50,000. So you can see how you can really jump up quick in terms of what you can defer or put into your 401k, even with low salaries, using your spouse. Okay, we have to be careful when you have multiple 401ks. Let's say your spouse works for another job, and she or he also contributes to their 401k at the other job. Both those are limited to $19,000. So if he or she's contributing, let's say, $5,000 on their own at their other job, they can only do $14,000 with your S corp. In that situation, I would just suggest that the spouse increase their own deferral at their other company, unless maybe the investment objectives or options aren't as good as your I-401k and solo 401k. And yes, you and a spouse can still have a solo or individual 401k because you're married. So you can still put that into one plan, an economical 401k, if you will. We also have to be aware of husband and wife attribution rules. So this is very common. We'll have husband and wife both running their own business. Let's say husband's got a very successful mortgage company and the wife's an engineer, and she's got her own company as well, right? And let's say the husband has chosen to have a 401k for him and his staff, but the wife's like, we don't want a 401k at our engineering firm. That is okay. Okay, that is all right, provided that the husband doesn't, let's say, meddle or help manage the wife's business, and vice versa. The wife doesn't meddle in or help manage the husband's business, provided that we keep those businesses separate. Husband can have a 401k in his business, and the wife can choose to not have a 401k in her business. I want to touch on the LLC conversion to S corp because this can kind of blow some people up. If you're used to maxing out your SEP IRA or 401k with your LLC, just your garden variety LLC that shows up on Schedule C of your individual tax return, you're going to be limiting yourself when you go to S corp land, because now it's based on wages and not total income. Now, you still might have a significant tax savings by going to an S corp, and we can help you navigate through that. Okay? Remember, all the tax here that you might save, and I'm putting that in air quotes, they're really tax deferrals. You have to pay that back. If we're maxing out 401ks because we want the tax deferral, then that's great and all. Just when you go to retire, you'll be paying that money back. As you might be aware, you can defer $19,000 into what's called a deductible 401k, or they can also do a Roth 401k. So most 401ks have two components: traditional, if you will, or pre-tax, and then post-tax, or Roth, if you will. So you can chop that up however you want between pre-tax and post-tax. The company portion is always going to go into the pre-tax account. Why? Because the company must take that as a tax deduction. So yours can go into Roth and the company must go into pre-tax, or you can put all this into pre-tax. Anyway, this is a lot to digest. We've tried to simplify this. This could be an hour conversation. So we'd love to help you out. Give us a call. Love to model this out for you, see which way works the best. Send us an email. Check us out on the internet. Again, my name is Jason Watson with the Watson CPA Group. Thank you.